Okay, hey, take a look at my screen here. I just wanted to kind of pull up the illustration for you all. This is an example of a child that's 5 years old. I actually have 5-year-old twins, and they've had a policy since they were right before they turned 2. So their numbers are obviously a little different than this. However, I do have numerous clients because I really specialize and I like to offer these children what I call trust funds for kids to a lot of my parents in place of a 529 plan, which I believe is probably the worst thing you can invest in if you're trying to accumulate funds for college. See, we're not held to just college with this. We can use this for anything. All right. So this is an example, 5-year-old child. You see they're 5 years old right here. Okay, now we're just paying $200 per month, which is $2,400 per year. Imagine, just kind of think with me for a second here. Let's say, my oldest son, who's 17 now, he played travel ball starting at age 7 or starting at age 9. I'm sorry, but even before that, he was playing t-ball at 6 years old. Then he played machine pitch, and every year we played, it got more and more expensive. Okay, so I'll just use that example. At age 8 years old, guess what? He had fees for his travel team. The fees were $3,500, right? So able to take $3,500 from this total here, which is $5,279. That's your money. But instead of withdrawing it from the bank like most people do, or take it from their savings or what have you, that money is gone. Now in place, you're going to have the insurance company give you their money because they're looking at it like, wow, you have this money. You can borrow ours for a simple interest. Great. No worries. Right. So you take the money here and then you just kind of pay yourself back as you go along. $50 a month. I don't know, $100 a month. Maybe you want to pay it every year. Maybe you decide not to pay it. But all of my clients, we come up with a plan for them to have a plan to pay the money back. I don't care if it's $25 a month. The idea is you want to treat this just like you own the bank. This is your bank. So if you had to pay your mortgage, you would pay that. You got to pay your car loan. You got to pay your credit card bill. Why wouldn't you pay yourself back? The cool part about this is no one's reporting you to a credit agency. No one's going to pull your credit. No one's going to hound you and knock on your door for the money, because if you don't want to pay it back, you do not have to. It is voluntary. You do that at your own accord. Okay. But just to give you an example, at 5 years old, now imagine college time comes around. Or maybe that first car at age 16, you have money to put towards that used car. Well, what I really love about this product, I talk about college, but what I love about this is now you're in college, you can go get the student loans if your child doesn't get a scholarship or what have you. But there's so many options out here for scholarships now, outside of athletic scholarships, that you don't have to just depend on financial aid or some type of student loan to fund your college. You can get some of that in scholarships. But if you don't, let's say you don't, your child comes out of school around 23 years old, I'm sorry, you now have over $74,000 to put towards that student loan. So you don't have to defer the loan. And then when you defer the loan, it automatically doubles. See, that's where people get in trouble with their student loans. They don't touch it and it doubles because all they hear is, oh, I don't have to pay. It's not going to impact my credit. Oh, no, you don't have to pay. But what they don't do in reading the fine print is you should pay at least the interest accrued on. So if you have a $400 student loan note, you should be paying at least the interest. In most cases, around $125 to $130 a month. But this young adult, they don't know any better. All they know is if I don't pay, it's still not going to impact my credit, right? So they defer the loan and they just forget about it, right? But now by the time that deferment ends in 2 or 3 years, that student loan is doubled. Well, along the way, if they would have just paid the interest on it, just $130 a month while it's in deferment, they would have saved themselves over 80% of what that cost is now, right? But in this scenario here, you have $74,000 to pay towards your student loan. Now, you don't have to dump that money all in there at one time. Maybe your kid graduates from college and they have a $50,000 loan bill. You can pay this monthly. You can take all this money and dump it if you want to, or what have you. But now your child has an option, or you, who's the owner as the parent of this policy, you have the option to say, all right, son, your student note is $400 per month. We're going to contribute $300 a month for you, and you're going to contribute $300 as well. So we're going to pay a little bit over than what they want, and we're going to knock this thing out, right? So what I love about this is now we're not talking about college anymore. We're beyond college. Look at age 65 when this child is now retirement age, right? 65 years old, you got $1.5 million in retirement. Now, I've been doing this since 2008, folks. And I have yet to see someone with $1 million in their 401k. I have yet to see it. And I've looked at over 100, over 200 different 401ks that my clients have had. I have not seen someone with over $1 million. So you mean to tell me that just by starting at age 5 years old, you put your child in a position to have $1.5 million in tax-free retirement, because they're not going to receive any 1099s or any taxes on this. This is not taxed. This is tax-free money. So they can start taking $10,000, $5,000 a month, maybe $40,000 a year. They decide, or you as the owner, you decide if you have not transferred ownership to your child. This is very important that you do not transfer ownership to them until they understand this banking concept, because we know how that story ends. They'll run through the money, right? So if your child is educated on how this works, oh, they're going to be an asset, right? But now think about this. Let's think along the way. Think about your journey. Maybe you got married at 38, 37, maybe younger than that. Imagine at 37 years old, if you had $232,000 to put towards your wedding and your honeymoon. But the cool part about this is when that 237 came out, it wasn't going to leave your account. It was going to still keep growing. And the insurance company was again going to give you their money. And all you got to do is pay it back with simple interest. See, that's the beautiful thing about this. But we got to start. Your child's future self is depending on you to take action. It's very simple. This isn't any crypto or any stock market. This isn't, Bitcoin. This isn't real estate. This isn't any of those things. This is just guaranteed returns that you only participate in the gains on, period. If the market's doing really bad, you just don't get anything, but you don't lose money either. That's the beautiful thing about this. So I want you to kind of think about these different time periods in your life where now you're 43 years old, you have $359,000, or emergencies come up, vacations. What we do without vacations, if we're going to take a vacation, $5,000, $10,000, $20,000, we'll pull it from our family banking over here and we put it all on the credit card. And when we take this money from here, we just pay the credit cards off. So we do what? Keep our credit scores high, no balances on our credit cards. That's how we got out of debt, by doing this. We have 8 policies, soon to be 9. I'm working on another policy now for my oldest. Okay. So this is just a very general scenario. I want to show you one more thing in terms of other living benefits with this policy. So I'm going to run a report here. I just want you to see with this particular policy, and it comes with all of our policies, it includes those living benefits. Okay. And that's super, super important, because most people, they get an illness, they don't die. You get cancer, you live. People have a heart attack and they live. Have a stroke, you live. Go skiing, break both of your arms, you still live. But it may require them to be out of work for a while, or at a younger age, maybe out of school for a while, right? So here's some of the living benefits. I want you to see this. If you become ill, terminal illness means you're going to pass away in 2 years or less. The insurance company is going to cut you a check for $1.5 million. Chronic illness, up to $30,000 a month. Now, this does not come from your death benefit. I'm sorry, it does not come from your cash value. It comes from your death benefit. So this is not coming from your cash value. Critical illness, up to $1 million lump sum. Right. And so what happens is, I'll give you a perfect example. I had a client who had a heart attack, and they rated from 1 to 3. And in his case, it was a level 2. So he was eligible, based on this policy, he was eligible for $60,000. So as the breadwinner in that family, he was able to get $60,000 while he was out of work for the next 4 months. So what they do, they went on vacation, they paid their mortgage up for the next 2 years, paid off a lot of their debt. So he actually came out better by having the heart attack, and no worries in his household. Wife didn't have to worry. The kids didn't have to worry. All he had to do was get his rest and relax, and he was able to actually improve on his lifestyle. So that's amazing. But this is what I talk about when I show you these illustrations, guys. I really want you to understand that $200 per month can make the biggest difference in your child's financial future, not just college. That's why I always say college and beyond, even before college. Again, I use that same example. Going to different camps, they may go to a camp at school, where they have to go travel for the summer. I had a client whose daughter went to Europe. She's in middle school. She went to Europe for 2 months in the summer, pretty much her whole summer. The trip cost $12,000 for her to do it. But it was an enrichment program and they really wanted her to go and she really wanted to go. It cost them $12,000 for that trip. And I think she took that trip at age 12. Well, in this example, at age 12, if that happens with your child, you got $20,000. You take the $12,000 from the policy, okay? And you just pay it back as you want. Maybe $100 a month, maybe $300 a month. I don't know. But you don't have to worry about that bill. You don't have to worry about creating more debt in your household, putting it on a credit card and trying to pay the credit card off. You don't have to worry about that anymore. Hey, I'll give you another example. What if something happens in your house right now? The AC goes out. Remember, you are the owner of this policy and the owner decides what happens in this policy. It doesn't have to be something for your child. You are the owner. You determine, the money comes to you. We had to replace both of our AC units 3 summers ago. It cost us $14,000. Where do you think I got the money? Pull it right from your policy, right from your policy. And I just pay myself to my policy back, $200 a month. Some months I don't pay, I stop. It's totally up to me. Because all the insurance company is doing is charging me interest on whatever that balance is at the end of the year, okay? So now what I want to show you is this. So we know we're paying $2,400 a year, right? So let's take $2,400. I want to show you the power of this, right? $2,400. And let's go all the way down to say 20 years, all right? So 2,400 times 20, all right? So that means at that point, you've paid $48,000 in the policy and you have 81,000, okay? Makes sense. You have 81,994. All right. You've obviously almost just doubled the money you had in there. But think about how many times you've probably used the cash value in this policy for things for your family. Maybe an investment idea comes up, anything comes up, right? But you have this money and you're staying out of debt in most cases. Okay. But now I want to show you something even better. Just as a quick example. I'm going to say at year 43, I think that's retirement age. Let's see, 43. Well, no, I'll do even better than that. I'll go year 35, right? So year 35 to year 50, right? So year 35 to year 50, you want to bring in a monthly income of $3,000 a month. All right, cool. Now, I want you to see what this looks like. So we're doing that just so you can see on the illustration. I like to let clients see this. So now you see here at year 35, the child's 39 years old now, and they're taking $3,600 a year, $3,000 a month. Now, understand this, the insurance company set this up as a loan because you took it as a loan, you didn't do a withdrawal, right? So you see the balance is what they're charging you, interest on the balance, all right? So you don't pay anything during that year. Now it's grown to 36,900. The next year's grown to 38, 40,000, 42,000, 45,000, and so on and so on and so on. But how about this? Now, you know, you're still paying $2,400 a month, right? Let's do this. Let me show you something here. All right. Let's just say you're still paying premiums. Let's say, you know what? I'm going to start paying this thing back at $250 a month. All right. Pay $250 a month, but I'm not going to start paying it till year 50, year 52, year 51. We'll do 51. All right. So 51 to, let's just do that. All right. See how far that stretches. I'm showing this for this example here. Now, what I want to show you for this example is now you're paying this money back. You didn't start paying it back right away. I just want to show you that you took this money all the way to year 43. All right. So you took $36,000, right? $36,000. All right. Now, what I want you to pay attention to now is you started paying back here. Here's where you started paying back. Started paying back. You see the interest starts to come down. Interest comes down. That's not a good example. Hold on here, guys. I messed my cash value up. I apologize here. I want to give you guys a very realistic idea of taking a loan out. Let's just do an actual loan. Let's say you take, I don't know, call it $20,000 out. And we'll even step the year up to, I don't know, year 20. All right. And that's just a one-time thing. You're going to take $20,000 out. for a loan. All right. And I'll do that at year 20. I'll even add a row. I want to do another loan even before that to kind of talk about the example of you using the money for an event, a life event or something like that. I want to show that as well. Let's say $6,000 here. And now we'll show you starting to pay back at year 615 to, I stretch it out 35, why not? And I'm showing you this example because I want to show you how are the money being restored. Messed up something here. I didn't put an amount. Sorry about that. Here we go. So let's say it's $7,000. Did I do that right? And then we want to start paying back at year 21. So there we go. Let's do that just for the example. And you're not, I'm making these numbers up. Like I don't have to pay $250. I don't have to pay the money back, but I want to show you why you want to pay yourself back, just to give you an example. So let's say now you've created up to $40,000, child 17 years old, as you see right here, right? Now year 18, maybe he's staying off campus. Maybe you want to, maybe he's buying some supplies to go to college with or what have you, but you pull a loan out for $7,000. See that? It says loan here. You pull out $7,000. So you took income, $7,000, right? Now, this is your accumulated value over here. Notice how this number continues to grow, all right? Even though you took $7,000 out here, right? You took $7,000 out here. Look, it still grew the next year. But your available over here is what you got to pay attention to. But now, 7,000 you took out, you only have 42 available here. Well, it drops to 38. I'm sorry. Do the math on that. 45 minus the 38. It drops to $38,000. All right. That's the $7,000 you took. You take 45,551 minus 7,000, you'll get this number here. Right. Now it still starts to grow because you're still paying $2,400 a year. All right. But if you notice over here, it's as if the money never came out. You never saw a minus over here. All right. Okay. And then you came back, you took $6,000 out at age 24 for whatever reason. All right. Your money still always kept growing over here because you use the insurance company's money. Why is this important? It's important because of compound interest. So we didn't interrupt the growth of your money that you're getting from paying this $2,400 a year. You know, some of it's going to insurance, obviously, but the bulk of it is going to cash value, to build your cash value. So notice, this is what's important. Your money was never interrupted from growing. And that is amazing. Now over here, it shows took from that $64,000, there's 80 really there, but I only have access to 64,000, you know, so I took $64,000 out, see the $6,000 difference. All right. Take income, money comes out. Okay. Pretty easy. Now I want to show this the right way because I don't want to show $250 yearly. I'm going to show it as if you're paying $250 per month. But unfortunately, the payment calculator for this example only shows yearly. So we just take $250 a month times 12 would be 3,000, pretty sure, make sure. Yep, 3,000. So that's going to be 3,000 a year we're going to pay back. All right. Now I want to show the power of now we're starting to pay it back. Notice I didn't pay back initially. Initially, we just took the 7,000. See, interest is based on the balance. So they charge us $357. The next year, $375. They charge us $394 because I'm not paying on this. So the balance is growing because they're adding the interest in every year. So this is year. This isn't interest just accruing daily like your mortgage or your credit cards or your car note or any other thing. This is simple interest. We even came back and took another loan out. All right. Now we're saying, all right, we want to pay some money back. All right. So now as we start paying back $3,000 a year, look, 3,000 here. We paid 3,000 this year, 3,000 this year. By year 31, we finished paying that. So you see your money's fully restored. Now the cash value is back equal again. See that? Both numbers match. And you made money the whole time. There is not another better product. There's not a better product out here for accumulating wealth for children and even adults. This is amazing. I mean, it's amazing, guys. So when I talk about cash value insurance, this could be done via whole life or IUL, which is what this is, stands for Index Universal Life. But the reason why I love the IUL in this example, especially when I'm dealing with children, is because it's flexible. You know, if times get tough, you can go down to paying as little as $50 a month on this policy. All right. Here's another cool part I want to show you. Let's just decide, let's just say at age, I don't know, for whatever reason, right? Let's just say at age 40, which is year 36, decide we don't want to pay for this anymore. You decide you don't want to pay, right? So we'll say here that we're not paying anymore. We're only going to pay for this thing through age 40. Watch what happens. Look, check it out. I'm showing we stop paying on it right here. We stop paying on it. But what is happening over here? It's still growing. No, it's probably not growing as aggressively as it was, but it's still growing. Still growing. Here's the cool part. Still got $1 million by age 60. And if they work and all this and they retire when people typically retire in this world, they retire at 65, they still retire with $1.4 million. Like, imagine them taking some money from here monthly and they don't have to pay this back. It's tax-free. This is the power of what this product does. This is the power of that. Now I want to show you an example here of taking a loan out. Yeah, we paid that loan back. I'm going to show you an example of taking a loan out and not paying it back. I just want you to see this. We'll leave the first one in that we paid that one back, but we're going to take another loan. All right. We're going to take another loan here at year. We'll do that. We'll do this loan at year 46. Let's do it at year 46. All right. Made a purchase. Let's say they made a purchase for the vehicle. Call it $80,000. All right. We're not going to pay that back. All right. We'll still keep this. Well, actually, we're going to still stop paying at age 36 as well. At year 36. I'm sorry. So now check it out. Look at this. Took $7,000. It took $6,000. We're going to start paying some of these loans off now. Started paying that back at $250 per month. All right. They paid it all off. Great. Then they came down here and decided at age 40, I'm not paying on this anymore. I'm tired of paying on this. Okay, I don't want this insurance policy anymore. I got enough in there where it's going to last the rest of my life. Great. All right, cool. Still continue to grow, as you see. Then at age 50, had to buy that pretty red sports car. Okay. All right. At age 50, spent $80,000. Okay. Said, I'm not going to pay that back. So you see on $80,000, the interest was $4,000 that year, $4,200 the next year, and so on, because they're never paying it back. And they're also not even paying on the policy anymore. But here's the cool part. At age 60, still have $1 million. At age 65, still got $1.3 million. Think about that. How was that for retirement? In addition to your Social Security and a 401k if you have it. You have 3 income streams now. But the reason why this is the best one, because it's tax-free. You're not going to receive no 1099 for this. So if you have not met with me, please set an appointment up with me ASAP for your child. Get your numbers together. $200 per month. What does this look like if you're paying $300 per month? Imagine. All right. Just imagine. I mean, we're talking about $200 per month is what we're talking about. Okay. So now if you do nothing and you pay all your loans back and all that great stuff, you know, obviously, like I mentioned earlier, and you pay on this until you retire. It's when you stop paying on it with just $200 per month, just to show you that again, in this example here, at age 65, $200 per month. At age 65, your child has $1.5 million. All right. Imagine how much of a powerful tool this could be when you need a down payment for a house. At age 25, you need down payment money. Grab it. And maybe you're paying back $200 a month to that. Maybe you buy an investment property for this amount of money that's making you income. All right. Here's an example of investment property. Let me show you. Just let me show you this. All right. I want to show you here, a year 24. Decide you want to pull some money out. Let's call it $100,000, but you found an investment property. All right. In year 24, great deal came up. All right. Then you say the tenant, let's say the tenant is paying a mortgage of, call it $1,200. All right. You're going to take of that $1,200, you're going to take half of that, just half of that mortgage. You're going to pay it back to the policy. All right. We'll go, I don't know how long that, what's that? $600 a month. Yeah. So I'm going to do $600 times 12 would be $7,200. So you're going to pay $7,200 a year. You're not even paying the whole $1,200. You're just paying half of it. The other $600, you're using it for yourself. Whatever you're doing with it, right? So you're 25 to, let's call it 50, because I'm not sure how long that'll go out before it's paid back in full. I just want to show you here for the illustration, the power of being able to use this. We're just operating like the banks operate. As you can see, came across an investment property for $100,000, paid cash for it because you was able to get a good deal because you made a cash offer. You made a cash offer. You said, the property might have been listed at 130. You said, I'll give you 100,000 cash. Can you prove that you have the cash? You have to prove you got the money. All you're doing is showing your insurance policy. That's all you got to show is show your cash value available in your life insurance policy. Once you show that to your agent, oh, it's done. Yep, they got the money. So you paid $100,000, right? You see $100,000 came out. Cash value dropped to $8,000 that you have available to yourself. But your policy didn't stop growing. Check it out. It kept growing as if you never took the money because you took the insurance company's money. So for taking that $100,000 every year, they charge you interest. So that year was $5,100. Didn't pay it. So now it's $105,100. So now they charge you $4,000. Oh, I'm sorry. You started paying on it right away the next year. You started paying on the next year. So that's why the interest is going to go down because you're paying $7,200 a year. Look at that. Look how it's going down. It's just interest. You're paying, you'll be fully restoring it. And notice how your money, your cash value is going back up. Check it out. By year 49, age 53, that property is paid for free and clear. Cash value is what? Fully restored. Fully restored. Come on, man. Fully restored. Now